Welcome to HYCM's workshop with myself, Giles Coghlan. Now, as we look ahead, this is the workshop and we're going to be looking at trading the Federal Reserve meeting. So a very good afternoon, good morning to you. If you can just let me know you can see my screen and hear my voice okay, that would be great. Just going to see who's, just as folks are coming in. Don't forget, as we talk about different entries, different exits, the whole idea of this workshop is that it's an educational workshop. It's not a signal trading service. And obviously, it can't be because market conditions are constantly changing. So this is just a look at what I'm looking at, and hopefully this will be helpful for you guys as well. But it's not a signal trading service or trading advice. You regulars know how this works. Warm welcome to you, Ignatius, Johan, Diaz, Janapala. Good to have you here. Just as other folks are coming in, I'm just going to be explaining what we'll be doing. We're looking at trading the Federal Reserve meeting this afternoon. It's a hotly anticipated meeting. And, you know, the Federal Reserve is the world's most important central bank. It does set the tone for stocks and currencies globally. And if you look at this year, we've seen the relentless dollar strength has been weighing on the yen, the pound, the Aussie, New Zealand dollar, the euro, and currencies around the world have been struggling with this extremely strong dollar. That's been bid on both safe haven bids and aggressive Fed monetary policy, as the Federal Reserve are expected to now hike interest rates up to 5% next year. And having been living in a low interest rate environment, that is a significant increase in quite a relatively short period of time. And obviously it's happening because of surging inflation. Headline inflation in the US is 8.2% odd. Core inflation is rising, and the Federal Reserve is having to act to crimp demand as quickly as possible. So we're going to just go through what we're looking at. Don't forget, when we're trading, we're looking to trade strength against weakness. So I'll be outlining the key elements that I'm looking for as we approach the meeting. Now, let's just come out of this and let's just look here at some little data we've just had out. Now, what we've just seen is this ADP employment data come out. Now, this is important because labor data has been relatively firm for the Federal Reserve. Now, once we start to see, and if we start to see, you know, falling labor data and people are losing jobs in the US, then that's the sort of thing that's going to make the Federal Reserve change their interest rate expectations. Okay, so at the moment we can see this is what the Fed's expected to do. And if you just take a look here, they're expected to hike interest rates up to 5% next year. They're currently at 3.125%, expected to hike by 75 basis points today. So you can see there's a 98% chance of a 75 basis point rate hike for today. So that is the expectations. And the interest rate is expected to go up to 5%. So what interest rate markets are sort of saying is that the Fed is going to keep hiking more aggressively. Okay. Now, when we have a good jobs print like this, ADP jobs, now you can see that that is well above the high of market expectations at 239. That increases expectations that the Federal Reserve is going to be more aggressive in the future. Now, yeah, Charles, employment is a lagging indicator, but it is a very important indicator nonetheless, and one the Federal Reserve will be looking at. So typically what you see in a downturn, and I was just looking at this earlier, is when you see, this is the blue line is the S&P 500. See, when you see the S&P 500 bottom, it tends to bottom a little bit earlier than jobs and the GDP and the earnings data. It tends to just kind of bottom sooner. So in other words, you can get stock starting to rise even as GDP is falling, even as labor's falling, even as GDP is falling. So this is in some of the big recessions that we've seen previously. So the fact that jobs are still fairly robust means that the Fed are not going to be so worried necessarily about hiking interest rates. So this just makes them a little more reticent and a little bit slower to potentially hike interest rates. Now, this is just one tiny piece of the jigsaw, okay? So this in itself is not going to change the Fed's mind, it's not going to move the Fed's mind, but it's why we've seen a sudden flush lower in stocks on that print. And if we just take a look at the S&P 500, what you can see is there's a sudden flush lower in the S&P 500 in a snap reaction in the expectation that that's, you know, a more negative environment for the Federal Reserve, that they will be able to hike interest rates more aggressively. And of course, this is going to form part of the mood music for non-farm payrolls on Friday. And jobs have been generally tracking slightly lower, but still quite robust. So this brings us to what to expect today. Now, the Fed have a problem. And if you look at the problem, I can show you that problem here. The problem is that inflation, GDP is falling, right? We had headline inflation is falling, but the core inflation is still rising. So headline inflation falling, core inflation rising, labor is generally tracking lower, but still quite robust. And, you know, we've only got to get a reading above 315 on Friday, and that's not necessarily a downward trend. That sort of breaks the back of that, you know, third consecutive month's loss. So what the Fed are expected to do is hike by 75 basis points. Now, the best tradable opportunity is going to come from the Federal Reserve saying that they will only hike by 50 basis points. So if we only see a 50 basis points rate hike from the Federal Reserve later, and the Federal Reserve indicate a more dovish outlook, this is what we should look for. So there's two things. One, if they're more dovish today, and if they hike by only 50 basis points and or signal a lower terminal rate of 4.5% for next year. Remember, the current expectations is 5%. So if they hike by 50 basis points or signal a lower terminal rate, then look out for some very strong precious metal buying. I particularly like silver buying, and also look for dollar downside, okay? Yeah, Charles says, if 50 basis point hike, US dollar is down like a rocket. Yes, exactly. So what we'll be looking for is, you could look at euro US dollar buying, dollar yen selling, look at pound US dollar buying. All of that would make sense on a 50 basis points hike. And S&P 500 buying, Dow buying, both of those would be very good, E-minis, whatever you're using to trade the S&P 500. So that is the best opportunity here. Going into the meeting, you know, expectations have been kind of increasing that the Federal Reserve are going to be perhaps maybe more aggressive, that the Fed is going to keep maintaining that aggressive stance. And remember, in July, there was speculation that Jerome Powell had made a pivot. So markets want to see a pivot from the Federal Reserve. And if we just take a look at the S&P 500, what we saw around Fed, now this was a 21st of October. This was pretty interesting. Right, so 21st of October on the Friday, which was here, we had Fed's daily sort of giving a little bit of a hint that perhaps the Federal Reserve wouldn't necessarily be as kind of hawkish as the market was expecting. Said, you know, we don't have to hike by 75 basis points. He sort of suggested it could be 50 basis points hike. Now that allowed stocks to rally into the event. We've now got up to an obvious resistance level, and we're now right at this technical crossroads, this daily descending trend line, and the S&P 500 just sat here waiting for fresh direction which of course makes a lot of sense depending on what the Federal Reserve do moving forward. So expectations are they're going to hike by 75 basis points and be slightly more aggressive. So by contrast, this could be a good potential short in the S&P 500 if we see the Fed hike by 100 basis points or more and the terminal rate goes above 5.25%. So that would be the exact opposite reaction. So if we see the Federal Reserve hiking by 100 basis points and they signal a higher terminal rate of 5.25%, they expect exactly the opposite reaction. Gold selling, silver selling, S&P 500 selling, euro US dollar selling, dollar buying. Okay, so if they do signal a higher terminal rate, now what they might do, they might sort of hike by 75 basis points, indicate that they're going to slow the path of hikes, but say that they might go longer. So watch out for that possibility. So they might kind of, because the Fed's got a conundrum really. If Jerome Powell comes out too hawkish, he's going to sink stocks, and he knows that. If he comes out too bearish, he's going to cause stocks to surge. He doesn't really want that. So what he might do is do a midway point and say, well, we're just going to slow the path of rate hikes, but we might be extending the terminal rate out. So just look out for that. So how that would look is at the moment we can see, look, the terminal rate is expected to be 5%. Now what he might say is, okay, we're going to hike by 75 basis points a day, fine, 50 basis points in December, right? But we may be looking at having to increase the terminal rate marginally. So maybe it will come to 5.25% as we go later through the session. So that's something definitively to look out for very, very closely as we head into the meeting. Just watch out for that midway point. And obviously another midway point is if they only hike by 50 basis points, but then they extend the terminal rate, you watch out for that dip being bought, okay? So that's something you have to be very careful of. So that would be if you get a midway point. So if they're dovish, if they hike by 50 basis points, but then they signal a higher terminal rate, you'll see a whipsawing action, okay? The other thing to mention, and you have to be aware of this, is yes, we're going to get the actual reaction, but we also get the press conference is going to be coming out at 6:30. Right? And watch out for the press conference to kind of signal the opposite of sometimes what's happened in the interest rate decision. So you just need to be aware that sometimes you get those kind of funny reactions when you get opposite reactions signaled in the press conference and you did in the interest rate decision. So that's what to look for. S&P 500, dovish Fed upside makes sense. You can use this trend line, get above this trend line, stops can be placed below it, get below the trend line, stops can be placed above it. You also got this 100 exponential moving average. Silver and gold, we'll just take a look at them quickly. Gold, you can see, got this nice trend line. If we get a dovish kind of Fed, then looking for a break of this trend line, okay, and a near-term target up to 1720 makes sense. Similarly with silver, again, if we get a dovish Fed, then look for a run up to 2150.22. That's a nice little area where we could potentially expect some more gains, and I'll be definitely looking very carefully for that kind of situation. If we can get a run back up to 21.22 on a dovish Fed, I'd be looking at that. First target would obviously be 21 into this overhead resistance area. If we get a hawkish Federal Reserve, then look for this to be retesting down to 1850 and then potentially look at this trend line breaking lower. One major index that I think is worth looking at is the FTSE 100. Just take a look at that. You can see that we have broken out of a nice kind of trend line here. a nice head and shoulders pattern. You've got left shoulder, right shoulder, head. We've broken to the upside. We've formed up into overhead resistance. But if we get any flush lower, back down to 7065, 7100, I do favour buying. A lot of bad news is priced in for the UK, and it is sort of, you know, due a potential reversal. FTSE 100 is trading at quite a low price to earnings ratio of around 8.5. The valuation of UK stocks compared to European stocks is it's a 20% discount. So even if we get a more hawkish Federal Reserve, we see a drop in UK stocks. I do favour buying, and stocks to be placed just above that 680 and looking for a target up to that 7450 region. That's something I quite like. I wouldn't like buying it now. I bought this personally on the break of the upside. Stops underneath 680. I just think the FTSE is looking too cheap and heavily sold off on a lot of bad news, and expecting a little bit of a push back up to 7450 is what I'm looking for. So that's definitely something just to keep your eye on as we go into the meeting. Yeah, Charles, I think Charles just puts that very well. Charles says markets dream of a pivot, which will not happen for months. And I think that's exactly what's happening. Some people, they really want this to be a recovery. And you can understand people maybe got invested in stocks, and maybe they bought in much higher up, 4.7, 4.8, and they want to see some of those gains come back, and they're just sort of praying, hoping for a pivot. But what Charles says does make a lot of sense, because the Federal Reserve has got to tackle inflation, and they've got to bring it down, and the Fed has maintained that very hawkish outlook. So definitely, this is not an event to guess beforehand. Absolutely no way. And we don't want to guess beforehand on this event, because there's just no way of knowing what's going to happen. And yes, the most sensible view is that the Fed's going to keep maintaining a more hawkish stance. But that doesn't mean, we have to worry. All it means is that if they are more dovish, we've got some great opportunities. So I was speaking to a friend at church the other night, and he was going to me, what's your view on stocks for the next sort of, 6 to 12 months? And I said, listen, honestly, I don't really have a big long-term view like that, because I'm trading short-term shifts. So my skill comes from understanding what markets are expecting, and then trading those short-term deviations. So I'm not married to any position. I'm not married to longs. I'm not married to shorts. I'm waiting to see what the market does. And as like Charles says, the markets are dreaming of a pivot, and that's right. Yeah, FTSE is a tough beast. It's just so hammered down, and I'm happy to define and limit my risk underneath that head and shoulders pattern. What's your view on New Zealand dollar? New Zealand dollar is such a beast at the moment, and I'll tell you why the New Zealand dollar is a beast, and it's one that I'm very cautious in trading the New Zealand dollar. I'll show you the New Zealand dollar index. If you look at the New Zealand dollar, the RBNZ is one of the most hawkish central banks, right? And we are seeing a little bit of New Zealand dollar strength come into the New Zealand dollar index. But if you look at the end of November 2021, if I told you that at this point here, the RBNZ became the most hawkish central bank of the major central banks, you'd hardly believe me, because the New Zealand dollar fell, all these points lower. So it fell roughly 35% after becoming the most hawkish central bank, before bouncing, okay, and making all that back up and then selling off again. So we have recently seen the RBNZ, they are more hawkish. We have seen some New Zealand dollar gains. I did take some Aussie New Zealand dollar shorts as the RBNZ went more hawkish than the RBA, but now I'm flat and I'm quite neutral on the New Zealand dollar. Did see some comments on the Squawk last night, just showing a little bit more wariness of the RBNZ. We just take a look at, here we go. So RBNZ's Hawksby was speaking last night. I'll just have a look at it. I just saw he was getting a bit concerned about house prices. Yeah, Deputy Governor Hawksby says rising interest rates will harm the labour market. That was it. Financial stability report. Some households will be challenged by rising interest rate environment. Okay, so just a little bit of it wasn't on housing, just a little bit of concern about the labour market. It's not as significant as I actually thought it was. But my view is the New Zealand dollar should remain supported on very hawkish RBNZ monetary policy, Charles. But whenever I'm trading it, I'm always making sure I'm defining my risk very carefully, because you don't want to be in an environment when you're sort of, long the New Zealand dollar, and the price keeps moving against you, like it could have done in November 2021. You could have been long the New Zealand dollar and be holding it through all that drawdown. So my view on the New Zealand dollar is, yes, it's still tilted to the upside on the whole hawkish RBNZ monetary policy, but I'm defining and limiting risk very, very carefully if and when I trade it. And I only traded it recently with that Aussie New Zealand dollar trade. You can see expectations are for the RBNZ to go up to 5.32%. Okay, so 5.3% is their short-term interest rate expectation. They're expected to hike. It's quite split between 50 and 75 basis points for their next meeting in November. And the expectations have just been ticking up for higher interest rates. So that should support the New Zealand dollar, particularly on deeper dips. But Charles, my view is, sorry, not Charles, sorry, Max. Sorry, Max, apologies for that. But my view on that is be very cautious about trading the New Zealand dollar. Make sure you define risk very nice. On big US dollar pop today, buy New Zealand dollar yen on turn at bottom. Yeah, that would be interesting. And you raise a good point there on the yen. Now, what we have to look out for the yen is Bank of Japan's intervention. Now, we've seen a couple of places where the Bank of Japan have intervened in FX markets. And if I just go to the daily chart, you'll see here, okay? Okay, dollar yen, sharply lower on Bank of Japan intervention, dollar yen short lower on Bank of Japan intervention. So if we saw, a really, hawkish move from the Federal Reserve and dollar buying, watch out for more intervention around that 150, 152 region. Be very careful of that, okay? So don't be buying the dollar yen on a hawkish FOMC decision, because the risk of FX intervention is extremely high, and you can get, caught into a significant slippage when you get these kind of markets moving, this quickly. You can see, when markets are moving this fast, you can easily get slippage. So make sure the best opportunity will come if we had a really dovish Federal Reserve, then selling dollar yen makes sense, but you may even see the Bank of Japan add intervention into that selling. And you could look for a run down to that 142 on a very dovish Federal Reserve. So that would be nice. Charles was saying, if there's a big US dollar pop higher today, buying New Zealand dollar Japanese yen on the turn at the bottom, that's quite a nice idea actually. And the rationale for that is the underlying New Zealand dollar strength, the underlying yen weakness, which should be continuing, but we have to factor all that in mind in with what the Federal Reserve do. So what I'll leave you with is the best. This is what I consider to be the best environment. If they're dovish today and hike by 50 basis points and or signal lower terminal rate, dollar selling, gold buying, silver buying, S&P 500 buying, euro US dollar buying, that's the best opportunity, okay? If they're higher, expect the opposite, and watch out for that mid, that mid kind of way position where they hike by you know, maybe 75 basis points or 50 basis points, signal a 50 basis points hike for December, but extend the terminal rate higher. Yeah, it's exactly what I think, Charles. The Fed are unlikely to be dovish, more likely to stand pat on expectations. That's exactly what I'm expecting. But watch out, because markets will try to read into these kind of narratives. So even if the Fed do stand put, watch out for potentially them trying to read into a more dovish, or, you know, if they are like giving some kind of hint. The market's going to be desperately looking for a hint. This is the best opportunity that I can see if it's in this dovish theme. Okay, folks, thank you very much. Charles, thank you for your comments. Max, thank you for your New Zealand dollar comment. That's always helpful to look at the New Zealand dollar, Max, because it can be a pain and can catch people out. Thank you all very much for attending. I hope your trading goes well, and I look forward to being in touch on Monday for the normal look ahead video. Thanks everyone now. Take care and goodbye.